Thank you, Ashokji. Good morning, everyone. Uh, I hope everybody has joined in the session, although there is still 1 minute to go to 7. I can wait for a minute. Those who have joined just can confirm in the chat box so that I get to know there are enough number of participants joined already. Good morning, Viraj. Good morning, Gajjar. Okay. Good morning, Pooja. Morning, Kushma. Good morning, Prachiti. Good morning, Shruti. Thanks for the confirmation and the wishes. I hope everybody had a good sleep and joined the session with a fresh mind. So let's start with the remaining portion of the Ind AS 102 share-based payments, which we have been talking about on Saturday. Good morning, Mohammed. So just a quick recap, what all we have discussed on that day so that we have a foundation for today's session. So we have understood the scope of the standard that the grants to employees, grants to non-employees, employee share purchase plans, and employee share-based payments settled by any entity within the same group or by any shareholder within the same group, right? And does not apply to the transactions to the shareholders like IPO, FPO, right issue, bonus issue, or any sort of private placement of shares to any of the investors in the capacity of the shareholders as such. Shares issued in business combination, because that is covered by Ind AS 103 specifically, so that is why it is excluded from here, from the scope of Ind AS 102, and the transactions which are covered under Ind AS 32 and 109, that is financial instrument transactions. Examples I had already discussed that day. Then we have understood the key terms like exercise period, fair value, intrinsic value, vesting period, vesting conditions. So all this stuff we have discussed in detail. I hope you had a revision if you got a chance. We have understood the definition of the share-based payment arrangement. Share-based payment arrangement is basically an agreement between the two parties. The party one is the company or the group company or the shareholder within the same group, and party two is the employee in case it is ESOPs by the company to its employees or group company's employees, or any other third party like supplier of the goods or services to the company, which has agreed to receive the consideration for the goods and services in the form of shares or in the form of cash, to be determined basis on the number of shares, right? Now, other party entitles, receives the rights to receive the shares or the cash basis on the shares if the vesting conditions are met. Vesting conditions are those conditions which are agreed upon between the two parties at the time of entering into the contract, right? Then we have understood the definition of grant date, the date at which, both the parties have the shared understanding of the terms and conditions of the arrangement, right? Shared understanding. And we have discussed this point in detail on that very date, right? Then measurement date. Measurement date in case of employees, it will be the grant date, and in case of non-employees, it will be the date when the services and goods are received or obtained by the company from the third party, right? Fair value will be determined if market prices are available, right? Shares are listed on the stock exchange of the company. Then basis on that, with some adjustments relating to the conditions which are there on the equity instruments were granted. And if the market prices are not available, then valuation technique needs to be applied on the measurement date, right? And in very rare case, when company claims that they cannot determine the fair value of the shares, then intrinsic value accounting can be permitted. Otherwise, it is prohibited, right? So there is a repeatable presumption only in very rare case when company claims that they are not able to determine the fair value. So I'm just revising whatever we have discussed last day, and then we will, kick off today's session. Then we have understood the terms vesting conditions, right? Vesting conditions are the conditions which needs to be satisfied over the vesting period, right? And vesting period is the period which is being, agreed by the company and the other party, during which the services needs to be delivered by the other party and vesting conditions needs to be satisfied. So conditions may be of two types: vesting, non-vesting. Non-vesting conditions are those conditions which does not have any impact on the eligibility of getting the entitlement to receive the shares of the company by the other party, right? So these conditions needs to be ignored. For this purpose, only vesting conditions needs to be focused upon. Vesting conditions may further be subcategorized into two types: service condition and the performance condition, right? Service condition is a simple service condition, like company says to its employees, if you stay with us for next 3 years, service conditions deemed satisfied. So if that is the only condition, then the employee just needs to do one thing: to stick with the company for next 3 years in order to receive the shares, right? So that is the service condition. We have covered examples as well as practical questions on this during the last session. Now, performance condition is the condition where some sort of performance, measurement KPIs, key performance indicators, have been agreed. Performance conditions may be related to the performance of the company as a whole. For example, revenue growth by 10%, EBITDA growth by 10%, or, market share, that is share in the market, grows from 10% to 15%. But if it is, based on the share price of the company, then that condition is called as market linked condition, and that needs to be ignored for our purposes, right? Only non-market linked related performance conditions, needs to be considered for this purpose, right? So any condition, any performance condition which is dependent on the performance of the share price of the company or the group company, that needs to be ignored for the purposes of determining the vesting of the equity shares to the other party. Then market condition, non-market conditions, we have discussed the examples, like share price must increase by 15%, total shareholders return must increase by 10%. So these are the examples of market conditions which needs to be ignored. And non-market conditions, which are performance conditions, like revenue must increase by 10%, market share should increase by 5%, right? So all these conditions are regarded as non-market performance conditions. These needs to be considered, right? What if conditions not satisfied? We have agreed that if vesting conditions not satisfied, then no amount will be recognized, right? No recognition will happen for any sort of expense, be it equity settled or cash settled. And if market conditions not satisfied, that is the conditions which are dependent on the share price of the company, then they are anyway ignored. So whether they are satisfied or not, we don't care, and we will continue to recognize the goods and services received, right? Then we have discussed some examples and the decision tree. Thereafter, we have understood there are three types of share-based payment plans. One is the equity settled, one is the cash settled, and the last one is the share-based payment transactions with cash alternatives, or you may call it a hybrid plan, right? Because this plan has both the features. It may be equity settled, it may be cash settled, right? For equity settled, whatever goods and services are in equity settled, whenever it is with the employee, then employee services are measured indirectly by reference to the fair value of the shares. But if it is related to with the non-employee party, then consideration for the goods and services needs to be considered as the fair value. If a company claims that they cannot determine the fair value of the goods and services, then only it is measured indirectly, right? That also we had discussed. In case of cash settled, liability gets reinstated at each reporting date and on the settlement date basis on the fair value of the equity shares, right? Then we have understood the accounting journal entry. So debit we will do to the either the asset or the expense, right? Employee benefit expense, inventory account debit, property, plant and equipment account debit in case we are purchasing inventory or PP&D from the supplier, right? So whatever is coming to us will be debited, right? And what is going out will be credited. So it may be either equity or the liability basis. It is a equity settled or the cash settled. So in case of equity settled, it will be credited to increase in equity, right? And basis on, if it is a cash settled, then we will, accumulate the liability year on year basis, right? Then equity settled transactions, we have discussed the measurement principle. Measurement date would be the grant date and recognition date would be the date on which the services and goods are received, right? If there are no vesting conditions, then all the expense will be recognized immediately. If there are vesting conditions, then it will be recognized over the vesting period, right? So all these things we have discussed. Then we have done these practical questions, and thereafter we have understood the cash settled plan. Cash settled plan, initial measurement happens on the fair value on the grant date, and thereafter the liability gets remeasured at each reporting date basis on the fair value available for the shares, right? And always whatever is the change in the fair value will be recognized in always profit and loss, never recognized in OCI, right? Never. Then we have done some practical questions around the cash settled plans. Thereafter we discussed the hybrid category, that is the share based payment transactions with cash alternatives, and we have done some practicals around that, right? So this is the catch up of the discussion which we had on day 1. Now today is day 2. We will start with the term modifications. So modification, as the name suggests, whenever there is any change in the plan later on. So once the plan is approved, companies may come up with some changes to that plan, right? The change may be, related to the conditions. The change may be related to the extension or reduction of the number of shares to be granted. The change may be related to the increase or decrease with the vesting period. So whatever type of change this is, that will be regarded as modification to the plan, right? Now, whenever any modification is done by the company in any of the plans which have been, discussed and agreed upon by the parties, the modification accounting gets triggered on the very same date, right? So that is the modification to the plan or the terms conditions, whatever it is. Now, modification can be categorized into 2 types. First type of modification, it is beneficial to the employee. Okay. When we say that modification is beneficial to the employee, it means either company is relaxing some of the conditions which needs to be fulfilled, or company is, increasing the number of shares to be granted, or company is reducing the exercise price to be paid by the employee, right? So whatever change, if that change is bringing some additional benefits to the employee, then it means it is in turn brings additional cost to the company, right? Because there would be certain resources which will flow from the company to the employees to make this plan beneficial, right? So there would be some additional cost, which needs to be, incurred and recognized by the company if the modification is beneficial. So in that case, we will account for that cost prospectively. Okay. So whatever that cost would be to the company for giving some additional benefits because some of the terms conditions are changed in favor of employees, that cost will hit to the P&L of the company prospectively. Prospectively means starting from the date of the modification, ending by the date for the remaining vesting period of the plan, or the date by which these additional conditions would, expected to be satisfied, right? So for the remaining period, this additional cost will be, incurred and recognized by the company. Now, beneficial to the employee may be in the form of increase in the fair value of the equity instruments granted, or increase in the number of equity instruments granted, or modification of vesting conditions so that it becomes more lucrative or beneficial to the employees. So any sort of modifications within the plan. So this is not the exhaustive list. This is just, example for understanding. So any sort of, benefit which is given as a, because of the modification or change in the plan to the employee will be accounted for prospectively from the date of the modification, right? From the date of modification, right? Now, if this change is not beneficial to the employee, right? So either the change can be beneficial or the change cannot be beneficial. So if it is not beneficial, then what we will do? We will ignore. So ignore means whatever the expense would have been recognized to the P&L had there wouldn't be any modification, the same will continue. So we will ignore all sort of modifications to the plan which are not beneficial to the employee, right? So it may be related to decrease in the fair value of the equity instruments granted, or decrease in the number of equity instruments granted, and modification of the vesting conditions to the detriment of the employee. So any terms conditions or, vesting conditions which are detrimental to the employee, we will ignore, right? Only in one scenario where number of shares are being changed, right? So earlier the plan says that, 100 shares to each employee will be awarded. Now the modification is plan says 90 shares to each employee will be awarded. Rest everything is same. Then the reduction of 10 will be, treated as a cancellation by default, because whenever we are going to accrue, for the next year, so we will do our calculations basis on the revised number of shares rather than the original, because earlier it was 100, now it is 90. So we will continue with the 90, right? And whenever we do the calculations for year 2 basis on the 90 number of shares, and, come up with the cumulative amount and deduct the recognized expense for the year 1, it gets automatically adjusted in the year 2, right? So as such, there is nothing different we need to do. We just need to calculate basis on the revised number of shares for the year 2 after this modification has happened. So what we have understood, whenever there is a modification can be of two types. Either it is beneficial to the employee or it is non-beneficial to the employee. If it is beneficial, then it means there would be certain additional cost incurred by the company to make it beneficial for the employee. So that cost we need to account prospectively from the date of the modification, right? And if it is not beneficial, we ignore, to do anything in accounting unless and until there is a decrease in the number of shares from the previous benchmark, then that gets accounted for automatically when we revise our calculations. Let's do quick question so that we understand how we are going to give effect to these sort of modifications. Okay. So on 1st of January 2005, entity A grants an award of 1,000 options, right? So 1,000 options award is granted by entity A on 1st of January 2005 to each of its 60 employees. So all in all, how many employees are there? 60 employees, on a condition to remain in employment for next 3 years, right? So 3 years is the period employees needs to serve with the company so that they become eligible to receive 1,000 shares each, right? So 3 years is the vesting period. The grant date fair value of each option is 5. So 5 rupees is the fair value of each share on the grant date. On 2005, at the end of 2005, entity's share price is dropped. So entity is a listed company, and in the market share price gets dropped, right? So on 1st of January 2006, management choose to reduce the exercise price of the option. So management, is reducing the exercise price to be paid by the employee on the exercise date, right? At the date of the repricing. So at the date of modification, the fair value of each of the original share options granted was 1, and the fair value of repriced option was 3. So the incremental fair value of each modified option is 2. Now, because of this reduction in the exercise price, fair value of this repriced option is 3 as against the fair value of rupees 1 on the modification date. So original options fair value on the grant date was how much? 5. So grant date fair value. So let's understand the question first. So grant date fair value was how much? 5 rupees for each option, right? Now modification date fair value of this option is 1. Now after modification, after changes, right? After modification fair value, it has become 3. So 5 rupees was, fair valued at rupees 1 on the modification date without changes, and post changes, it has again, restored back to 3, right? So incremental fair value between the pre-modification fair value on the date and post adjustment on the date is 2, right? So this 2 rupees benefit is additionally passed on by the company to the employees by changing one condition within the plan, that is reduction in the exercise price, right? At the date of the award, management estimated that 10% of employees would leave the entity before the end of the 3 years, that is 54 awards would vest. During 2006, it became apparent that fewer employees than expected were leaving. So management revised its estimate of the number of leavers to only 5%, that is 57 awards would vest. At the end of 2007, awards finally vested to 55 employees, right? So this is the question. Now, would you like to try or should I try this? So let me try this, and the next question you will do. So how the calculation will look like? So what is the estimate for year 1? So year 1 estimate is 54 awards, year 2 estimate is 57 awards, and year 3 actual award vesting is 55, right? So first of all, we will do the 54, 57 and 55, right? How many options? 1000 options, right? All in all, how many employees? Oh, sorry, employees we have already taken. What is the fair value? 5 on the grant date. So 54 employees in year 1 expected to vest 1000 shares into me 5 rupees into me 1/3, right? How much is the cumulative amount? 90,000 for the year 1. So year 1 actual expense would also be 90,000, right? Simple calculation, as such, no difficulty yet for year 1 at least. Now year 2. So year 2 we have understood that there is a modification, and in case of modification, what we have understood from the standard that we will book additional cost as well along with the original cost, right? So original cost recognition will continue the way it would have been had there been no modification. So 57 is the new number of employees expected as per the question. 1000 is is still the same, 5 is still the same, and it will be 2 by 3. So how much amount comes? So it is the total amount. So plus 57 into my 1000 into my 2 rupees. So 2 rupees is the additional benefit passed on by the company to the employee for next 2 years. So that's why we have taken 1 by 2, right? So plus total expense amount comes to 247. 247 minus 90,000. So for the year 2, the expense amount will be 1,57,000. Now, who has any sort of doubt or query on this calculation piece? Because this is the real thing which we need to understand. This is the effect of modification in the plan. So modification, whenever there is a modification which is beneficial to employee, the existing cost will continue to be recognized the way it would have been had there been no modification, right? Additional cost will also start flowing in to the P&L of the entity from the date of the modification. So in year 2, on the day 1 only, modification has been, approved and communicated. So for the full year, we have, considered this additional expense. Had this modification been done instead of first day of the year, somewhere in between, then we would have additionally incorporated the pro rata calculations basis on the number of days. Okay. So if this modification instead of 1st of January would have happened somewhere, say 16th of June in the year, then from this 16th of June only, we would have calculated the additional expense on a pro rata basis until 15th of June. Only original expense would have been there, right? So that you need to understand. But anyway, this is not relevant in this question. Now, in year 3, we know that only 55 employees finally, were there with the company completing the 3-year vesting period. So 55 into my 1000 into my 5 plus 55 into my 1000 into my 2. So total cumulative expense is 3,85,000 minus 2,47,000. So 1,38,000 would be the expense which would be recognized in the P&L in the year 3. So this is how the accounting for modification which is beneficial to employee, would be given effect. Any queries, questions? You can, ping in the chat box. Otherwise, just mention it's clear so that I can get an indication to proceed. Thanks, Shruti, on confirming it is clear. Thank you, Mohammed. Thank you, Pooja, for confirmation. Okay. Now, I have done one question. Now, the another question you need to, pick up. And I will be waiting for your responses in the chat box with the answer. But before that, let me discuss the question for you. Marathon Inc. issued 150 share options. How many share options? 150. To each of its 1000 employees. So 1000 is the number of employees. Subject to the service condition of 3 years, right? So in most of the questions, 3 years you would see as a service condition. So hardly, it is changed in the questions, but that is not the case that 3 years is the only service condition. It may be 1 year, it may be 2 years, it may be 5 years, it may be 10 years, and it may be zero. So, if there is no service condition, then and there is no performance condition, the awards will vest to the employees immediately, right? Fair value of the option given was calculated at how much? Rupees 129. So on the grant date, the fair value of the option is 129 rupees per share option. Below are the details and activities related to share-based payment plan. Year 1, 35 employees left and further 60 employees are expected to leave. Share option repriced as market value of the share has fallen as the fair value fell to 50 rupees. So the 129 rupees has fallen to 50, right? By the year end of year one. After repricing, they are now worth rupees 80. So this 50 is now restored to 80 at the end of year one, that is beginning of the year two. Hence, the expense is expected to increase by rupees 30, right? So 30 is the additional expense which will be hitting to the company on account of this repricing. 30 employees left and further 36 employees are expected to leave in the year two. And finally, in year three, company realized all in all 39 employees have left. Please show up the calculations for the modification or repricing, how the same will be accounted for in the books. So you just need to ping me year one expense amount, year two expense amount, and year three expense amount total, right? Whatever finally would hit to the P&L for the 3 years. So three amounts I need from you so that I get to know that you have understood the concept well and, is able to pick up the correct calculations. Thanks, Kusma, for the confirmation. So I'm waiting for your responses now. Your time starts now. Any luck with the answers? Is it calculations taking so much time? So Viraj is saying, sir, 102 employees left. What to do next? 102 employees left. How come 102 left? 104 employees left. 35 plus 30 plus 39. Okay. So what to do next is you need to calculate the expense amount now. You would be recognizing for year 1, year 2 and year 3 basis on this question. So Muhammad Abdul has come up with the answer for year 1. How much? 71 lakhs 94,750 rupees. Okay. Year 1. Okay. What would be year 2 and year 3? So Pooja has responded with the answer for year 1, 2 and 3. Okay. How much? 22 lakhs 62,500 for year 1, 44 lakhs, sorry, 44 lakhs 49,500 for year 2 and 28 lakhs 88,000 for the year 3. Okay. So I think by now many of you must have tried and I think you must have arrived to some answers. So let's see how the calculations would be in this case. So the repricing was done at the end of the year 1, right? So for the year 1, at least there wouldn't be any impact of the modification, right? So for the year 1, the expense would be the same as it would have been had there been no modification, right? And at the beginning of the year 2, when the modification has happened, so there would be some additional expense on account of favorable, or beneficial to employee modification done by the company, right? So for year 1, how many, number of employees were there? 35 have left. Sorry. 35 have left and 60 is expected. So net employees would be 905 for the year 1. Because all in all, how many employees were there? 1,000, right? So 1,000 minus 35 minus already left minus expected to left. So 905. Options per employee is 150. Fair value per option is 129. So period weight is 1/3. So what would be the total expense? Total expense would be 58 lakhs 37,000 and 250 rupees. Not sure if somebody has given this answer. Okay. Right. For year 2, again, we will calculate the number of employees. So 1,000 minus 65. 65 is 35 left in year 1 plus 30 left in year 2, right? So 65 have already left and 36 are still expected to be left by the company, right? So net number of employees for the year 2 calculations would be 899. Again, the option per employee is the same, fair value is the same, and the weight would be 2/3, right? And modification fair value is how much? 30, right? So for 899 employees, 150 options, 30 fair value, and 1/2 the weight for the modification will be added here. So this is the original expense. This is the modification expense, right? So this is how the calculation will be done for the year 2. And now for year 3, again, the 1000 is the number of employees minus all in all, how many have actually left by this date? 104, right? So 896 would be the number of employees to which the award will finally vest, right? 150 is the fair value, 129 is the fair value of the option, and 150 is the number of options, and 3/3 would be the weight for the year 3. And again, for modification, we will do the calculation same way. So 896 would be the number of employee, 150 would be the award, 30 would be the fair value, and weight will be 2/2, right? So the final amount will be this much. So Yuktika has come up with the correct answer for the year 1. So this is how the calculation needs to be performed, right? Now after seeing the solution, any doubts or queries you still have? So Kusma is asking, do we need to consider expected number of employee leaving also? Yes, because if there wouldn't be any employee who has actually left in year 1, and there would have been given only an estimate on the expected number of employees which would leave, then that needs to be factored in. So if there is a information available for the actual number of employees as well who are already left and further expected to leave, then both needs to be considered. Now, who are already left is anyway left, right? Plus who are expected to leave by the management, that also needs to be factored in. And that we have done in the previous questions as well, which we have done on the day 1. So Muhammad Abdul is saying, I have included the modification in year 1 as well. Okay, so that's the mistake, Muhammad. So I have, explained that modification will come into effect only from the date of the modification, prospectively, right? Not retrospectively when the plan was started. So modification expense will flow to the P&L only from the date of modification, right? So 2-3 revisions I think I would like to do at this point. Number 1, number of employee calculation will be done basis on the total number of employees available on the date of grant minus expected number of employees to leave the organization which management estimates, plus any existing number of employees which is given in the question who have already left, right? So already left employees plus further employees which are expected to be leaving the company by the management, both employees needs to be considered for the calculations. Rule number 1. Rule number 2, we will always do the calculation basis on the cumulative expense by applying the weight 1/3 in the year 1, 2/3 in the year 2, and 3/3 in the year 3, right? If it is 4 years, then 1/4 in the year 1, 2/4 in the year 2, 3/4 in the year 3, and 4/4. Once we have arrived at the total cumulative expense for the year, then we will deduct minus the expenses which we have recognized in the previous years to come up with the number of amount of expense to be recognized for the current year, right? This is the correct way of the calculation. For the modification, rule number 3, for the modification always be accounted for only if the modification is beneficial to the employee, and if it is beneficial to the employee, then it will be accounted for prospectively from the date of modification. Okay. So from the date of modification only, modification expense will flow to the P&L. Now, post modification, the original expense will continue to flow to the P&L the way it would have been had there been no modification, plus the modification expense. So original expense will not get affected by the modification. Original expense will continue to flow the very same way, right? It will not be changed. And modification expense will also gets added to the expense from the date of the modification, right? If it is clear, please, give me an indication in the chat box so that I can proceed. Clear? Thanks, Pooja, Yuktika, and Mohammed for the confirmation. So we have understood the modification accounting. Now, the next point is cancellation of the award or settlement of the award, right? So company may come up with the cancellation or company may settle the awards as well before, they get vest, right? So company, can do anything with the awards, modification, cancellation, or settlement, right? So whenever the company cancels any award or settles any award, then definitely, we need to do the accounting for the cancellation or the settlement, as the case may be, also on the date on which cancellation and settlements are done, right? Now, cancellation / settlement of the grant. Cancellation of the settlement. Let's understand first cancellation. Account for as an acceleration of the vesting conditions. Oh. Recognize expense immediately the amount that would have been recognized for the services received over the remainder or the remaining vesting period. What does it mean? It means that suppose the award was granted for 3 years, right? And after year 1, company announces the cancellation of the plan, right? So once the plan is announced to be cancelled, then year 1 expense had already been recognized because the cancellation is announced on the year 2 start date. Now for year 2, the expense which would have been recognized had there been no cancellation announcement, plus year 3 expense which would have been recognized in year 3 had there been no cancellation. Both the year amounts, that is year 2 amount and year 3 amount, will be recognized immediately in the P&L on the date of cancellation. So cancellation means preponement of the expense which would have been recognized otherwise over the remaining vesting period now needs to be recognized immediately on this date of cancellation, right? Getting my point? So cancellation triggers immediate recognition. Cancellation triggers immediate recognition. Please note down, cancellation triggers immediate recognition. Of remaining vesting period expense. On the cancellation date, right? So this is the cancellation impact. Now, many of you might, have a doubt that award is cancelled. It means equity shares, or even if it is a cash settled, cash will not be paid by the company, or equity shares will not be issued by the company to the employees, right? I agree. So nothing will be issued to the employees, or cash will be paid to the employees if the award is simply cancelled. Then why we are recognizing the expense in the P&L? because company is actually not issuing any shares or not giving any cash to the employees, then why we are recognizing this expense? Because there is no cost to the company, right? Are you getting this doubt? Now, since standard says to do this accounting, that on cancellation we need to account for the remaining vesting period expense immediately. So we have certainly no option but to do whatever is being asked by the standard, even that is not getting digested to us. But on this point, various industry leaders have raised the point to IASB, and IASB committee is discussing this issue and matter. Till the time there is no further pronouncement or changes made by the IASB, we have to continue with this accounting only, right? So even if the awards are cancelled and there wouldn't be any cost in real terms to the company, standard requires us to recognize the expense immediately on the cancellation date, and hence we would be doing so, right? Any questions on this? Then I will discuss settlement. Once you confirm that you have understood the cancellation, pure vanilla cancellation we have discussed now. Now I will discuss settlements and see what would be the difference if there are settlements apart from cancellation. But have we understood the cancellation impact? Cancellation impact is simple. Triggers immediate recognition of the remaining vesting period expense. That's it. Nothing more, nothing less. Please confirm to me in the chat box if it is clear or you want me to repeat. Thanks, Kushma, for the confirmation. Now, settlements. Suppose whenever the company enters into settlement or does any sort of settlements apart from the cancellation, then this settlement might result into the payment to the employee, because now company is cancelling the award. So certainly employees, will not like it, because they have served some period out of the total vesting period. Say it was 3 years, and after 1.5 years, company came up with the cancellation decision. Then employees may not like it and gets demotivated. So it will affect the performance of the employees as well, because they will, not like the company management for cancelling their awards, right? So company might come up with some payment to the employees or aggrieved employees because of this decision. So that payment also we need to understand how will be accounted for apart from the cancellation. So cancellation is one piece, settlement is another piece. For cancellation, the impact is remaining amount which would have been recognized otherwise over the vesting period will be recognized immediately on the date of cancellation. That is cancellation solved. Now, if there is any payment as well apart from the cancellation to the employees, then how that needs to be accounted? Payment on cancellation. Because of cancellation, payment is made. Then settlement is treated as repurchase of the equity interest. That is deduction from the equity. And if payment made exceeds the fair value of the equity instruments granted, the excess shall be expensed off. So suppose company makes the payment. If payment is in lieu of the cancellation, then it will be treated as repurchase of the equity interest, which otherwise would have vested to the employee, right? Because what I am doing now, I am saying to my employees, that dear employees, because I have cancelled your awards, so I will be making some payment to you on account in lieu of that cancellation. Okay. Now employees are happy. They agreed to receive the payment. Now that payment needs to be accounted for, because this payment is in lieu of the cancellation. So it will be treated as like I am asking my employees to give the right entitled to you by the plan, that is to exercise the share. So I am repurchasing that equity right from the employees and giving them some cash, right? So I am repurchasing their right because of this cancellation. So that's why it will be treated as a repurchase of equity interest. That is, it will be deducted from the employee. Repurchase of equity means that, okay, what I do when I buy back the shares, whenever I buy back the shares, then I reduce my equity. Yes or no? Yes. So same fashion, I am doing the buyback of the rights to my equity by the employees. So it will be treated as a deduction from the equity, right? So that is, same logic. Now, if this payment made to the employees exceeds the fair value of the equity instruments granted, then excess shall be immediately accounted for in the P&L. So suppose if the fair value of the share granted was say 10,000 and company has paid say 10,000, then 10,000 will be deducted from the equity. So entry would be equity account debit to bank account 10,000, 10,000. Equity account debit to bank account 10,000, 10,000. If the payment exceeds the fair value of the awards, suppose company has made additional payment of rupees say 5,000, 15,000 has been paid, then what would be the counting? Equity account debit 10,000 to bank account 15,000. Now 5,000 will be debited to the P&L because this is the additional expense company has incurred by making the additional payment to employees to make them happy. So this expense, will be hit to the P&L. Immediately 5,000 would be the additional expense because company wise originally liable to pay only up to the fair value of the equity instruments, but now company has decided to pay additional amount over and above the fair value that would have been vested to the employee if the plan was not cancelled. Then additional expense will be recognized in the P&L on the date of payment, right? If share-based payment includes liability components, then remeasure the liability at fair value on the cancellation or settlement and then account for an extinguishment of the liability. So if the plan was not equity settled but the cash settled, and in cash settled plan we have studied that we need to reinstate the liability at each reporting date and on the settlement, right? That's the rule we have already studied and we have done practicals around that. Now, in case of settlement, before the settlement, liability needs to be reinstated at the fair value of the equity on the date of settlement, and thereafter, settlement entry will be accounted for. Repurchase of equity, vested equity instruments. So payment will be treated as deduction from the equity, and if fair value exceeds, the additional expense will be expensed off. Let's do the question first. Anara Fertilizers Limited issued 2,000 share options to its 10 directors. Okay. 10 directors, 2,000 share options for an exercise price of 100. The directors are required to stay with the company for next 3 years. Okay, 3 years is the vesting period. Fair value of the option estimated on the grant date is how much? 130 rupees per share. And expected number of directors who would continue with the company and in turn will get the shares vested are 8. So out of 10 directors, company expects only 8 directors will be there finally after the end of the 3-year period, right? During the year 2, there was crisis in the management and the management decided to cancel the scheme immediately. It was estimated further as below fair value of the option at the time of the cancellation. So at the time of the cancellation, fair value of the option is how much? 90. And market price of the share on the cancellation date was how much? 99. There was a compensation which was paid to directors and only 9 directors were currently in employment. At the time of the cancellation of such scheme, it was agreed to pay an amount of rupees 95 per share option to each of the 9 directors. Show how the cancellation will be recorded. So initially there were 10 directors. 3 years was the vesting period they need to serve. 2000 options will be vested to them once they complete the 3 years period with the company. And fair value of the option was how much? 130. And exercise price is also given. Exercise price is how much? 100 rupees. Here it is, right? Now, on the grant date, fair value is 130. Expected number of directors who will be there by the end of 3 years is 8 on the year 1. In year 2, company announced the cancellation and, negotiate the settlement with the directors. So fair value of the option on the cancellation date is rupees 90, right? And market price of the share on the cancellation date is 99, right? Now, at the end of the 3rd year, once the cancellation is announced, at that time, there were 9 directors to whom 95 rupees per option, is finally paid as a settlement amount. So these are the facts of the question. Now, in year 1, how many directors, company expects would be there? 8. Right? So 8 is the number of directors. Now, fair value of the option is what? 130. That is given in the question only. And number of option is 2000, right? So total amount by multiplying these 3 values comes 20 lakh and 80,000. Period weight is 1/3. So expense for the year 1 would be how much? 693,333, right? So this is the simplest calculation, right? 8 employees expected, 130 is the per option fair value, number of option is 2000 and year 1, so weight is 1/3. The amount is 6,93,333 rupees for the year 1 expense. In year 2, company has announced the cancellation and enters into settlement with the directors. So on that date, 9 directors are, there with whom the settlement has, taken place, right? 130 is the fair value of the original award and number of option is 2000. So 23,40,000 is the final expense amount, which, would be recognized. Out of this 23,40,000 expense amount, whatever has already been recognized will be deducted and the remaining amount will be recognized in full, right? As it is the cancelled. Now, remaining amount, expense for the year will be how much? Since the award is cancelled, 16,46,667 rupees. Now, cancellation compensation we also need to calculate. Number of directors, how much? How many? 9. 95 rupees is the cash payment or settlement amount agreed to be paid to them. 2000 is the number of options, right? So total amount, compensation amount comes to 17,10,000 rupees. So 17,10,000 is the compensation amount the company is paying to the 9 directors in lieu of the cancellation of their award, right? So this is the cash amount the company is paying, right? Now, how much amount will be deducted from equity? That we need to calculate now. Number of directors is how many? 9. Fair value is how much? 90. That is given in the question on the date of cancellation. And number of options are 2000 for each director. So total amount which would be deducted from equity is 16,20,000. and payment we are making is 17 lakh and 10,000. So we are making additional payment to the directors by how much? 90,000. So this 90,000 would be the additional expense which will be charged to the P&L immediately on the date of the cancellation and settlement, right? Now, we need to understand the journal entries for both the years. So year 1, debit, employee benefit expense and credit equity. This is the amount we had calculated for the year 1. As such, there is no complexity in year 1. This is a simple, straightforward calculation. Being expense recognized for year 1, right? So year 1 is sorted. There shouldn't be any doubt, right? Year 2, debit again, employee benefit expense, credit again to equity, or basically SBPP, share-based payment plan, right? Now, how much is the amount? 16,46,667 rupees, right? So this is the remaining amount that would have been recognized had there been no cancellation, now recognized on immediate basis on the date of the cancellation, right? Being remaining expense recognized immediately on account of cancellation of the award. So this is the remaining expense we have recognized in year 2 on the date of cancellation. So this is the cancellation accounting, right? Cancellation accounting we have done. Now we have to do settlement accounting. So settlement accounting is debit employee benefit expense by how much? 90,000, because 90,000 is the additional cash we are paying to the employees. Credit cash. How much cash in total we are paying? 17 lakh and 10,000. And credit equity. How much? By 16 lakh and 20,000. So 16 lakh and 20,000 is deducted from the equity. Sorry, it is a debit, okay, not credit. So placement, I will correct. So it is a debit, right? So equity is also debited and 17 lakh 10,000 is credited. So 90,000 is the delta amount, which is the additional cash payment over and above the equity deduction, right? And this 16 lakh 20,000 calculation we have already, done here in the working note. 90 rupees is the fair value of the equity option on the date of the cancellation, which was given in the question here. Any question on this? Have we understood the impact of cancellation and the impact of settlement on our accounting whenever the cancellation and settlements, takes place? If there are any questions, please ping me. So Yuktika is asking, but there won't be any shares to buy back. Then why we will be deducting in equity share? So your question is very good, Yuktika. So why we are deducting from equity? That is your question, right? Why we are debiting equity? So although we are not issuing any shares and we are actually not doing the buyback as well, but accounting, mirrors what, accounting would be in the case of the equity issuance and the buyback. So whenever we don't issue, we still credit equity share-based payment account, right? Equity share-based payment account, right? So when actually the shares are issued, then only this share-based payment accounts gets debited and, credited to ESC, equity share capital, as well as security premium, right? That we have done on the day one, right? In the practical questions. So whenever we finally issue the shares, we credit it to the equity share capital and the securities premium. Till then, we use a notional account, which is sitting in the equity only, by the nomenclature of share-based payment awards, right? Now, when that award gets cancelled, because award has been cancelled, so as such, there were no shares with the counterparty to offer to us for the buyback, and we are not actually doing the buyback of the shares. But because we have done the cancellation, it takes the color of, I am buying the right to my company's shares from those, employees, right? So employees would be receiving the shares had there been no cancellation. Now there wouldn't be any issue of shares. So hence I have repurchased that right from them, right? So they cannot demand after the settlement any of the shares from the company. That's why I have deducted it from equity share based payment awards only. Why? Because this is the credit made to here. Now, if this award is settled or cancelled, then this would be deducted from the equity only. And if I have made any additional payment, so that is the fresh expense I am incurring now on account of settlement. So that will be debited now to the P&L in the employee benefit expense only, because these are given to employees only, right? So anyway, it is an employee benefit expense only. So now Shruti is asking, the condition is done in year 2. So why the expense is there in year 2 but not year 3? Okay. So as we have discussed, whenever cancellation happens, right? Whenever cancellation happens, the remaining total expense, which otherwise would have been recognized over the remaining vesting period, now needs to be recognized on immediate basis on the date of cancellation, right? So expense, the total expense, which otherwise would be recognized in year 3, year 4, or year 5, as the case may be, now needs to be recognized immediately on date of cancellation. So this is a preponement of all the expense which otherwise would have been recognized over the periods will be recognized immediately on the date of cancellation. So that's why there is no expense in year 3, because award is cancelled in year 2 anyway. So the total expense is already recognized on the date of cancellation. So there wouldn't be anything left. Now, Yuktika is asking what will happen to the balance remaining in the share based payment account after the repurchase entry. Okay. So that also we have, touched upon in our day one discussions. So once the awards either is completed, that is the shares are awarded, then shares, gets issued by crediting this account to the equity share based payment account debit to equity share capital to securities premium, right? Now, since the awards are cancelled, now if there is any balance still left in this share based payment account, it will be transferred to the general reserve or retained earnings. Clear? I hope I am able to answer to both of you, Yuktika and Shruti. Let me know if somebody else has any other queries on cancellation or on settlement. Else, I can proceed with the next topic, or let me know if you want break now or after the concept discussion, so that whenever we come back after the break, we will start with the next topic or practicals. So I'm indifferent. Break now or break after the concept discussion. If somebody can confirm, I can, accordingly proceed. Okay, break now. Fine. So let's have a break of say 15 minutes, and we will, resume at 8:28. Okay. Okay. Can somebody please confirm in the chat box if we can resume? Okay. Thanks, Mohammed, for the confirmation. So now, last piece of the concept for the standard is group share-based payment plans. What does that mean? As the name suggests, group share-based payment plans. Group means a group in which may be of more than one entity, like parent company, subsidiary company, their JVs and associates. So all this may be a group. So right. So within that, there might be a parent company issuing the stock option plans for its subsidiary companies or vice versa. Right. Now, whenever there are group plans, so we just need to understand what is the impact of them in the books of the parent company as well as in the books of the subsidiary company. So for that, to understand that, we have a flowchart here just to ease this concept. So here the first question is, does the counterparty, that is counterparty is the employees, for example, right, get my equity instruments? So if, just a minute. So if yes, the answer is yes, that is the company is issuing equity shares of its own to the employees, right, then it will be treated as equity settled. If the answer to this is no, then the next question comes, does the counterparty get the equity instruments of some other entity within the same group? Right. So suppose there is a company ABC Limited. Okay. Now ABC Limited announces a ESOP for its employees. Okay. Right. Now under that plan, ABC Limited said that we will give you the shares of our parent company, which is suppose XYZ Limited. Okay. Parent P. Okay. Or said, I will issue you the shares of my subsidiary. Say PQR is a subsidiary S, but not ABC's shares. So if ABC issues its own shares, then it is a equity settled, right? If ABC issues either the shares of its parent company or the shares of its subsidiary company that is within the same group of another entity, then the next question is, do I have to provide those instruments? That is, am I the settler? That is, I here means ABC, right? Does ABC has the obligation to settle? If the answer is yes, then it will be treated as a cash settled share based payment option. If the answer to this question is no, then it means ABC is not obliged to settle anything under this plans. Hence, it will be equity settled expense for the ABC at least, because ABC does not have any liability to settle this obligation, right? Now, if ABC if the answer to this question, that is the shares of the other entity, is no, then the counterparty gets the cash or the other sets based on the fair value of either the equity instruments of ABC or any other entity, be it parent or subsidiary of the ABC, right? So either equity shares will be there or cash will be there. If the cash is there, then does ABC have the obligation to settle? Yes, then it is a cash settle. And if the ABC does not have obligation to settle anything, then again it will be equity settled, right? And if ABC does not have any obligation, then it will not be in the scope of the Ind AS 102. So let's discuss this concept for different scenarios one by one for a better understanding. Then we will come back to this chart, okay, which we have just discussed. Group based share plans when shares are being granted. So this is the scenario where shares are being granted, not the cash, right? Shares will be issued. Now, whose shares will be issued? Parents' shares will be granted by the parent. So parent will issue the shares and parent's share will be issued to the subsidiary's employees. So employees are of the subsidiary giving the services to the subsidiary, but parent will issue the shares and parents' shares will be issued to the employees of the subsidiary, right? Now, in parents' consolidated financials, this plan will be treated as equity settled. In parents' separate financial, this plan will be treated as equity settled because no cash is being paid. Only shares will be granted. Who is granting the share? Who has the obligation to settle? It's parent, right? Parent is giving the shares of its own company, parent, to the employees of the subsidiary company. Now, in this case, because subsidiary does not have any obligation to settle anything, hence it will be treated as equity settled for the subsidiary as well. Right? So if I correlate this scenario with our previous example, suppose ABC Limited was the subsidiary, right? And XYZ Limited was the parent, right? Now, employees are, employed by ABC Limited. Employees are giving their services to the subsidiary company. Parent said that I will give you the shares of my own company, that is XYZ shares will be given by the parent company, XYZ itself, to the employees of the subsidiary, right? Now, in this case, because subsidiary ABC Limited does not have any obligation to settle anything under this plan, hence the expense will be treated as equity settled for the subsidiary company. Now, since parent is giving the shares only, it will not give any cash. So it will be equity settled for the parent books of accounts as well, right? Because no cash is being given. And again, in the consolidated financial as well, it will be equity settled only, right? Scenario 2. Group share based plans when shares, not cash, are being granted. Subsidiaries shares granted by parent. So earlier the scenario was parents shares granted by parent. Now obligation is still with the parent to settle, but what will be given? Subsidiaries shares, not the parent's share, as we discussed in the previous example, right? Now again, so subsidiaries ABC, and parent is XYZ, right? Now employees are employed by the subsidiary company, that is ABC, who are giving their services to the subsidiary. Now parent has the obligation and discharged by subsidiaries shares, that is ABC's shares. Now, in subsidiaries financial statements, again, because subsidiary do not have any obligation, so it will be equity settled only, right? Because subsidiary has no obligation to settle anything. In parents' separate financial statement, because now parent is issuing not parent's share, but the subsidiary shares. Now parent does not have subsidiary shares or cannot issue subsidiary shares, so they have to buy the shares of subsidiary for the settlement purposes. Hence, they will be discharging this, obligation by, payment of cash, right? So they will be treated as cash settled in the books of the parent standalone financial statement. Why? Because parent cannot issue in its own books subsidiaries shares. It can only issue its own shares. If, as in the scenario 1, he was issuing its own shares, it was equity settled for the parent. But now in scenario 2, even if the obligation is to discharge in equity shares, but those equity shares can only be discharged when the parent has those shares in his hand. So parent has to buy these shares first by, cash payment. So when there are, shares to be bought for the settlement purposes by incurring the cash payment, so it can be equally regarded as cash settled for the parent, because parent anyway not discharging his obligation by issuing equity shares, but discharging its obligation by transferring the shares of subsidiary which can be purchased in cash. Now in parent's consolidated financial statement, it will be equity settled, because for the group is a one legal entity, right? And in one legal entity, shares of the subsidiary are being issued by the subsidiary, so it will be treated as equity settled obligation in the consolidated financial of one legal entity. Because for one legal entity, it is again equity settled only, because group is discharging group shares. So group is discharging the obligation in group shares. So group shares can be of parent shares or can be of subsidiary shares. So for the group, it will be equity settled. Correct? Let's see scenario 3. Group shares based plans where shares are being granted. So again, cash is not given, shares are only given, right? But now in this case, parents' equity shares are granted by subsidiary. Now, subsidiary has stepped into the shoes of settler, right? Earlier two scenarios, parent was the settler. Now the subsidiary is the settler, right? Now, in this case, first see what the settler's books of accounts will do. It will be treated as cash settled. Why? Because subsidiary is settling, but settling in what? Parents' shares. Right? Parents' shares. Now, parent shares cannot be issued by the subsidiary, right, in its own books. So, settler cannot issue, or subsidiary cannot issue the shares in this case. Hence, it will be a cash settled only, because settler, subsidiary here needs to buy the shares of the parent first, right, in order to settle. So that is a cash settled for the settler. In this case, that is a subsidiary. Now, in parents' separate financial statement, no accounting, because parent is not doing anything in this case, right? So no accounting at all. And in P's parents' consolidated financial statement, it will be again equity settled, because ultimately one legal entity, one group is settling the obligation by issuing the shares of any group entity, be it parent or be it subsidiary. So whenever the group settles the obligation by issuing shares, so for the group consolidated financial statement, it will be treated as equity settled only. So for the consolidated purpose, it will again be equity settled, right? Fourth scenario. Group share based plans when shares are being discharged. So again, in this scenario as well, obligation is settled by issuing shares. But who is issuing the shares and whose shares are being issued? Let's check on that. Subsidiaries shares issued by subsidiary. So subsidiaries settler and subsidiaries shares are issued, right? So subsidiary is issuing its own shares, right? In this case, in subsidiaries financials, it will be equity settled, because subsidiary is the settler and subsidiary is issuing equity shares. Again, in the parent's books, there wouldn't be any accounting as such, because parent is not doing anything in this transaction, right? Now, in consolidated financial statement, it will again be equity settled, because for the group, obligation is discharged in shares, not in cash, right? So when group settles in group's shares, it is equity settled. When group settles in group shares means any entity within the group shares, right? So group settles in group shares, it is equity settled for the consolidated financial statement. Scenario 5. 4 scenarios we have covered, which were related to the settlement in shares. Right now, 5th scenario is talking about the settlement in cash. So here the shares are not being issued, but the cash is being, paid. So these are the cash settled plans. Now, who is settling? Parent is settling, granted by parent. So parent is the settler, right? And cash is determined basis on parent's shares value. So parent's share value is the base on which the fair value of the cash to be settled is to be measured. So parent's fair value of equity shares will decide how much cash will be, paid to the employees. Now, parent is the settler. So in P's separate financial statement, it will be cash settled because settlement is being done in cash. In subsidiaries financial statement, subsidiary is not doing anything. So subsidiary has no obligation. So it will be equity settled for subsidiary because subsidiary has no obligation to settle this, right? And in consolidated, again, it will be cash settled because parent is discharging cash determined basis on the fair value of the parent shares. So it is a cash settled in the standalone as well as standalone in the consolidated CFS, right? Scenario 6. When group share-based plans are being granted, that is cash is being granted, who is the settler? Granted by parent. So parent is the settler, right? And whose shares will determine the fair value? Equities shares. So subsidiaries shares, right? Earlier scenario, it was parent shares settled by parent. Now it is subsidiaries shares fair value based cash settled by parent. Now, in subsidiaries financial statement, because subsidiary has no obligation to settle. So again, it will be equity settled, right? In parent separate financial statement, it will be cash settled because parent is discharging the obligation in cash, and in consolidated as well, it will be cash settled because group is discharging the obligation in cash. So in separate standalone financial statement of parent, it will be cash settled because parent is discharging in cash, and in group's financial statement, group is discharging the obligation in cash, so cash settled. But in subsidiaries financial, because of no obligation at all, it is equity settled, right, for the subsidiary. Now, again, the cash is being paid, but who is the settler? Granted by subsidiary. So subsidiary is the settler. And basis on whose shares? Parents' shares fair value, right? The cash will be determined, how much cash to be paid. Now, in this case, because subsidiary is settling and settlement is happening in cash, so it is a cash settled for the subsidiary now because subsidiary has the obligation. In parent's financial statement, because parent is not doing anything here, so subsidiary is discharging in cash, so parent is not doing anything or not playing any role in this transaction. So a standalone financial statement of parent, there wouldn't be any accounting, right? No accounting. And in consolidated financial statements of parents, it will be cash settled only because group is settling the obligation in cash. Subsidiary discharges in cash or parent discharges in cash. Anyway, it will mean group is discharging in cash. So when group is discharging the obligation in cash, it will be cash settled only for the group as well, right? Next scenario. Again, cash is being granted and subsidiaries fair value is being taken as a basis on which the fair value of the will be determined, how much cash needs to be paid, and who is the settler? Subsidiary, right? So subsidiary is the settler and fair value will be determined basis on the subsidiary's equity shares. Now, in separate financial statement of subsidiary, it will be cash settled because it will be settled in cash only. So cash settled. Parent has no role, so no accounting, and consolidated financial statement, same logic applies, cash settled, because group is settling the obligation in cash. So these are the 8 scenarios which we have discussed, where we have discussed both the equity settled plan as well as the cash settled plan when the shares are issued by subsidiary or when the shares are issued by parent, or when the cash is being paid by the subsidiary or when the cash is being paid by the parent, factoring into whose shares are being issued by the settler, right? So all the scenarios we have covered, whatever could be there. Now let's get back to this chart. Now again, we are back to the company. Does the counterparty get my equity instruments? Yes, it will be equity settled because the settlement is taking place in equity. No. Then does the entity is getting other group entities equity shares? Yes. ABC or the entity is the settler? Yes, it will be cash settled. Entity is not the settler, no obligation. So equity settled, right? This leg is cleared. Now, if entity is not getting any other groups equity shares, then it means entity will be the counterparty will be getting the cash. If the cash obligation is sitting with me, yes, then it is a cash settled. No obligation, so equity settled. And if there is no obligation to settle, then the transaction is not within the scope of Ind AS 102. Now let's me take if there are any queries. So Yuktika is asking, but in the parent company, we can show as equity issued for cash in case 3. Okay, let me go back to the case 3. Case 1, case 2, case 3. Here you are talking about, right? So this scenario says shares are being granted. So cash is not being granted. Shares are being issued. So at the top of the scenario, what is being discharged is written, right? So here cash is not being paid, but the shares are being given to the counterparty. Now, who is the settler? Subsidiary is the settler. Whose share fair value will be computed? Parent's shares fair value will be computed, right? So basis on the fair value of the parent company's shares, how much cash needs to be given is settled by the subsidiary, right? This is the scenario. Now, in this case, you are saying in the parent company, can we show as equity issued for cash? In the parent's company books, can we show equity issued for cash? Equity issued for cash. Sorry, I did not understand. Okay, let me explain this scenario again. Maybe, that will help you to clear your doubt. In this scenario, settler is the subsidiary and fair value is computed based on the parent's shares. Now, in the subsidiary's separate financial statement, it will be treated as cash settled because subsidiary is the settler. So subsidiary has to buy the shares of the parent and pay to the employees, right? So it will be making the payment in cash, or other way around, we can say settler is not issuing its own equity and hence it is a cash settled because settler cannot issue other companies equity. That is so logical now. So ABC Limited cannot issue shares of XYZ Limited, or I would say Tata Steel Limited cannot issue shares of Tata Consultancy Services and vice versa, because company can issue its own shares only, right? To settle an obligation. It cannot issue the shares of any other company within the same group. It can only buy the shares of that company in order to settle the transaction, right? If equity shares have to be delivered to the employees, right? So hence it is a cash settled for the subsidiary at least. Now, in the parent's standalone financial statement, because neither the parent is issuing equity shares, nor the parent is settling this obligation. So parent has as such no role to play here. So in parents' books, there wouldn't be any accounting triggered. But because for the group, when the group prepares the consolidated financial statements, it consolidates the parents as well as all the subsidiaries financial statements. Now for the subsidiary, it was cash settled because subsidiary cannot issue the shares of another group entity, that is the parent within the same group. But when we see the settlement happening from the group's perspective, so group is settling this obligation in the form of shares of the group. So group shares means any of the entities' shares, because ultimate settlement is happening in shares. That's why from the perspective of the group, it is a equity settled transaction. So whenever you want to assess for a particular subsidiary or the parents standalone or the parents consolidated, what it would be, whether it will be cash settled or equity settled, you need to step into the shoes of that company financial and look who is going to settle and in what the settlement takes place. If the settlement is taking place in the shares of that very subsidiary whose financial statement you are preparing, then it will be equity settled. If the settlement is taking place in the shares of some other group entity, then it will be at least cash settled for this entity, because this entity cannot issue the shares of another entity. But from the group perspective, group is settling the obligation in the group's shares, right? So that's why it is equity settled for the group or consolidated financial statement purposes. I hope, Yuktika, I am able to clear your doubt. If you still have anything or somebody want to ask anything, please do ask right here, because this is an important aspect to understand. If suppose you get a full-fledged, consolidated question on consolidation question, and there might be an adjustment pertaining to this activity of Ind AS 102, then you have to be crystal clear about the concept. Otherwise, doing all the adjustments fine in the consolidated financial, you may miss on equity settled or cash settled classification, and that will, impact your 1 or 2 marks in the question as well. So we have to be very clear when it will be equity settled, when it will be cash settled. And the thumb rule is equity settled when equity shares are delivered, cash settled when cash is delivered, right? So if subsidiary is settling by issuing equity shares, its own shares only it can issue, then equity settled. If subsidiary is settling the obligation but by purchasing the shares of another entity, it will be cash settled for the subsidiary, right? And for the group perspective, it will always be equity settled whenever the settlement takes place in shares, and it will always be cash settled whenever the settlement takes place in cash. Please let me know if the concept is clear. Just write in the chat box so that I can proceed. Pooja is saying clear. That chart helps much to quickly understand. Thank you, Pooja. And since I had already uploaded these PPTs on the portal, you must have been able to download, right? Okay. Thanks, Aksha, for the confirmation. Okay, let's see what would be the look like question on this concept. And this is the question from your study material itself. A parent grants. Who is granting? Parent is granting. Parent company. 200 share options to each of the 100 employees of subsidiary. So employees belong to subsidiary. How many number of employees? 100. Parent is, the settler in this case, because parent is granting. What it is granting? 200 shares, right? Conditional upon the completion of 2-year service with the subsidiary. So parent is saying to the employees of the subsidiary company that look at this plan. I will be giving, I means parent will be giving or holding company will be giving 200 shares to all the employees of my subsidiary company if those employees complete the 2-year period with the subsidiary company, right? So parent is announcing the plan, means parent is the settler, and settlement will be done by parent to those employees who fulfill the 2-year condition with the subsidiary, and what will be given? 200 share options, right? The fair value of the share options on the grant date is rupees 30. So 30 rupees is the fair value on the grant date. That is the date on which the plan has been announced by the parent. At the grant date, the subsidiary estimates that 80% of the employees will complete the 2-year period service. So out of 100 employees, 80% employees will be there who will be eligible finally by serving the 2-year period service. That is the estimate made by the subsidiary. This estimate does not change during the vesting period. And finally, this estimate came true, right? At the end of the vesting period, finally 81 employees complete the required 2-year service period. The parent does not require the subsidiary to pay for the shares needed to settle the grant of the share options. Pass necessary journal entries for giving the effect of the above arrangement. So parent company will issue 200 shares of the parent company to the eligible employees of the subsidiary company after the vesting period is being over. Right? That is the question in one line. And fair value of the share of the parent company, share option of the parent company on the grant date is rupees 30. Pass the journal entries to give effect to the above arrangement. Thanks, Shruti, for the nice words. So I want you to give a thought what would be the accounting in this case, and thereafter I will discuss. So I'm waiting for 60 seconds for you to come up in the chat box, at least with the answer how much expense will be recognized in year 1 and year 2 for this. So Shruti has come up with the answer for how much? 2,40,000 in the year 1. Okay. I'm waiting 30 seconds more for the others to respond. Viraj is saying 4,80,000 in year 1. Okay. So almost doubled what Shruti has said. Okay. Okay. So I think while others are still doing the calculations, let me quickly discuss the answer. So this is the suggested answer, as you know, as required by paragraph B53 of the Ind AS 102. Over the 2-year vesting period, the subsidiary measures the services received from the employees in accordance with the requirements applicable to the equity settled share-based payment transaction as given in paragraph 43B. Okay. Thus, the subsidiary measures the services received from the employees on the basis of the fair value of the share options at the grant date. An increase in equity is recognized as a contribution from the parent in the separate or individual financial statement of the subsidiary. Okay. The journal entry recorded by the subsidiary for each of the 2 years is as follows. Year 1, employee benefit expense account debit, that is P&L debit. 2, equity contribution from the parent. 200 into my 100 employees into my 30 rupees into my 80% employees finally is estimated to be, staying with the company by the end of the vesting period, and 1/2 is the weight. So amount comes to 2,40,000, right? This is the expense amount which will be recorded in the books of the subsidiary in the year 1. So as far as calculation is concerned, 2,40,000 is the correct answer. So Shruti, your answer is correct. So Viraj, I think you might missed to apply the weight 1/2, right? For the year 1, right? In year 2, what would be the expense? Finally, how many employees are there? 81 employees, 30 is the fair value, and 200 is the number of options into my 2/2, right? Minus 2,40,000 already recognized in year 1, right? So 2,46,000 would be the amount which will be booked in the year 2, and entry would be again employee benefit expense account debit or remuneration expense, whatever is the nomenclature you like. 2, equity contribution from the parent, right? Now, as far as the calculation is concerned, there shouldn't be any issues because we have done lots of practicals till now. So calculation is easily understandable, right? The only thing now we need to see what is different in this accounting is the credit leg of the journal entry, right? Credit, what the subsidiary is crediting here? Subsidiary is crediting here to equity, that is contribution from the parent. Okay. Because who is the settler here? Parent is the settler, right? Parent company is discharging the obligation by issuing what? By issuing what? The equity shares of whom? Of parent, right? So parent is issuing the equity shares of the parent to the employees of the subsidiary, right? So can I say that parent is incurring some expense on behalf of the subsidiary company? Can I say that? Yes, because parent is discharging the obligation towards the services received by the subsidiary company from subsidiaries employees, because employees are not working for the parent company, they are working for the subsidiary company. So ideally subsidiary company should be liable to pay the salary and other benefits to the employees, but in this case parent has assumed that obligation to discharge. So parent is incurring some expense for the services received by the subsidiary company from its employees. Can I say this? Yes, I can say this, right? Now in this case, what would be the accounting? So parent will say that I have made the payment on your behalf, so which I will recover from you, right? So parent says to the subsidiary, since I am incurring this expense or settling this expense on your behalf, because benefits are not received by me, benefits are received by you, so I will be accordingly getting this reimbursement from you. So either the parent has the choice to book the creditor, subsidiary as the debtor, sorry, subsidiary as the debtor in its books of account, or subsidiary can book a creditor, a parent in its books of account, or otherwise it can be assumed that parent is investing in the equity shares of the subsidiary. That is the parent's contribution, right? Because parent has discharged obligation to a third party, that is the employees of the subsidiary. In nutshell, either it can recover that expense from the subsidiary by creating that subsidiary as a debtor in its books, or it can say, okay, I have made investment in your company, right? So I am contributing. Same is the case with the subsidiary. Either the subsidiary can discharge by reimbursing the expense to the parent in cash, or subsidiary can record instead of creditor to the parent as a investor to the parent, right? So that's what the subsidiary is doing here. So subsidiary is debiting to equity, that is contribution from the parent. So equivalent number of equity shares will be considered as being issued to the parent company by the subsidiary for the same fair value. So equity is being increased, right, in both the cases. Is the journal entry logic and the concept clear? How the transaction will impact the books of the subsidiary and the books of the parent? Now, in this solution, in the study material, entry is not given for the parent company's books, right? Only the subsidiary company books. Now, you tell me what would be the journal entry in the books of the parent in this case. So, in this case, parent will debit what and credit what? So parent will debit investment in subsidiary, right? And credit equity shares being issued, right? So investment in subsidiary account debit to equity, investment in subsidiary account to equity, right? By the same amount in the year 1 and year 2. Okay. Let's do one more question on this concept. I hope the logic and the concept is clear. If there is any doubt, I am happy to discuss that first before moving to the next question. Okay. So let's see this question. A parent company P is the parent, grants 30 shares to 100 employees, each of its subsidiary company. Okay. S. So subsidiary company is S. So P is parent, S is subsidiary, grants 30 shares, right, to 100 employees of subsidiary. 100 employees of subsidiary, right? On the condition that the employees remain in employment for next 3 years. So 3 years is the vesting period. Assume at the outset and at the end of years 1 and 2, it is expected that all of the employees will remain employed for all the 3 years. At the end of the year 3, none of the employee has left. The fair value of the shares on the grant date is ₹5. The company S, yani subsidiary, agrees to reimburse company P over the long-term arrangement of 75% of the final expense recognized by S. So 75% of the expense will be reimbursed by the subsidiary to the parent, right? What would be the accounting treatment of in the books of company P and company S? Again, the question is from your study material only. So would you like to give it a try? So I just want you to try the questions, at least come up with the correct calculations, even if not with the correct debit or credit lag, that we can discuss and deliberate. But at least I expect everybody, coming up with the correct amount of expense for the year 1 and year 2, because that is the basic necessity. Otherwise, the question will derail. So you just mention me year 1 expense and year 2 expense and year 3 expense. That's it. Then I will discuss the journal entries. Okay, so Pooja has come up with the answer of year 1. How much? 3 lakhs. And year 2, 4,80,000. Okay. Viraj is saying, yes, 1/2 application was left. Next answer, it will be corrected. Good, Viraj. I hope you made the mistake in the session and you will not repeat it in your exam. So more mistakes done at home, is beneficial. Because you come to know about all the possible mistakes in that case. Yuktika said 5,000 rupees each in all years. 30 into 100. Sorry, I'm not able to understand how 30 into 100 will be 5,000. And thereafter, there is a series of chats from you. I'm not able to follow them. If you can write what exactly you want to say again. Muhammad is saying year 1 to 3 expenses 5,000. So 5,000 is the constant expense for all the 3 years that Muhammad is saying. Okay. Company S expects to recognize an expense totaling rupees 15,000. That is 30 shares into 100 employees into 5 rupees per share, and therefore expects a total reimbursement to be 11,250. That is 15,000 into 75%. That is 75% expense it will reimburse. So company S therefore reimburses to company P how much? 3,750. 11,250 into 1/3 each year. Okay. So 5,000 is the expense for each year. That's correct answer. Now, what would be the accounting by S? Accounting in the books of the subsidiary company. In each of the years 1 to 3, company S recognizes an expense in the P&L, the cash paid to the company P, and the balance of the capital contribution as it has received from its parent company, right? So general entry would be employee benefit expense account debit by how much? Rupees 5,000, because year 1 expense is 5,000. Cash, how much? 3,750 rupees. It is a reimbursement by the subsidiary company to the parent company, because 75% of the expense is, getting reimbursed. To equity, that is contribution from the parent, that is investment by the parent in the subsidiary. So we are issuing equity shares to the parent company for the balance reimbursement, because that is not being settled in cash. So that would be treated as a investment by the parent company in the subsidiary company, because parent is actually discharging this obligation on behalf of the company, right? So the parent will not do it for free. So it will treat as an investment in the subsidiary. So investment will be increased, right? So subsidiary is recording by crediting it to equity. So 1,250 will be credited to the equity. So this is how the journal entry will look like in the books of the subsidiary company in all the years, year 1 as well as year 2 as well as year 3, because there is no change in the amounts to be recognized year over year, right? Now, in the books of company P, how the entry will look like? Entry will look like investment in companies S, that is investment will be debited in the standalone books of the holding company, parent company. So company S is the subsidiary. So investment in subsidiary will be debited by how much? The amount which is not being reimbursed. So 1,250. Cash and bank, it is receiving for 75% of the expense incurred. So 3,750 will be debited to the cash and bank, and the credit for full amount of expense 5,000 will be done to equity, because 5,000 worth of equity shares will be issued by the parent company to the employees of the subsidiary company. So to recognize the grant of equity instruments to the employees of the subsidiary company, less partial reimbursement from the subsidiary, right? This would be the entry in all the 3 years of the parent company for recognizing the expense, as there is no change in the books of the holding company. Correct? Right. So everybody was correct in the calculation. So this is how, the accounting by the subsidiary as well as the parent will look like in their respective books whenever the plans are being announced by the parent company or the subsidiary company, and vice versa for their employees. So whatever the 8 scenarios we have discussed, you just need to revise those 8 scenarios and master it, so that you will not, make a mistake in this journal entry debit credit. Otherwise, the calculations you have already understood, right? The only thing is we need to understand how the expense will be recorded basis on the scenarios. So let's see what are the disclosures required by the standard. So now this all the concepts we have discussed, I suggest all of you to do the practice. There is a weekend coming, Saturday, Sunday. So on this Saturday, Sunday, you just do practice all the questions, examples, illustrations, as well as the, questions for practice in your study material. And that would be enough, because study material is, crafted very nicely, including all the good examples and the practical questions. Disclosures. Now there are certain disclosures required by this standard for all the, share-based payment awards the company, has announced. What are those? First, the nature and the extent of the share-based payment arrangements that existed during the period. So, which all plans were there during the period? We need to explain what is the nature and extent of those share-based payment arrangements. That is a description of each type of a scheme. If there are multiple types of schemes, then all those plans needs to be disclosed with a description along with the journal terms and conditions. That is, what are the vesting conditions, what are the performance conditions, on the basis of which eligibility will be, determined, that which all employees or non-employees, as the case may be, will finally, get the right to receive those shares or the cash basis on those shares fair value. Now, the number of weighted average exercise price of the share options we need to disclose. So what we need to disclose? Weighted average exercise price. And number, how many shares are actually exercised by the employees during the year. So this disclosure can be, populated by drafting in a tabular form. For example, how many shares options were outstanding at the beginning, which could have been exercised? How many are granted during the period, that is added to that? How many are forfeited or cancelled otherwise during the period? How many are exercised, that is taken by the employees by, crediting the shares to their demat account by the company? And how many finally are outstanding balance of the number of options which are yet to be exercised by the employees at the end of the period, exercisable at the end of the period. And we need to also present the weighted average share price and the date on which the options were exercised. So because numerous employees might have exercised their right on, different dates, so we will be calculating weighted average share price of those options exercised, right? Then if the share fair value was not determined basis on the market value of the shares, but rather were measured basis on the valuation techniques like binomial model, Black-Scholes model or any other fair valuation techniques, then we need to disclose how the fair value has been determined, which techniques or methodology has been used for, and definitely this exercise are done by the valuers, right? So we obtain the reports from the valuers and, give the necessary details here to comply with this disclosure requirement. The effect of the expense on the entity's profit or loss and the financial position, that is the total expense recognized and the liability at the end of the period. So how much is the total expense for the current year debited to the P&L, we need to mention, and how much liability for the current period is there as on balance sheet date, that also needs to be disclosed. So this is a sample disclosure made by one of the large listed company. So this is how the disclosure look like in audited annual financial statements of the company, right? So what the company is saying, share-based payment plan is the heading. Then following table provides an overview of the existing share options of the plans of the company. Vesting period in years, contractual term in years. So scheme 1, 2006 was the year in which it was announced. So plan name was 2006 plan. And scheme 2, 2005, long-term incentive LTI plan. So vesting period is 1 to 5 years, 1 to 3 years, and contractual term is 7 years in both the cases. The stock options vesting are subject to services and certain performance conditions, mainly pertaining to certain financial parameters. So financial parameters means parameters other than the share price, right? So if they are dependent on the share price performance of the company, then those conditions will be ignored, as those will be market conditions. But company has clarified here that performance conditions are dependent on certain financial parameters like revenue growth, EBITDA growth, profit growth, whatever, right? Financial parameters. Now, how it will look like the movement in the number of stock options and the related weighted average exercises prices are as follows. So this is the comparative period and this is the current period, March 22, right? 2006 plan and long-term plan. So both the plans are disclosed. If there are more plans, then all the plans needs to be disclosed. But in this case, company has only 2 plans, hence disclosing the 2 plans. So we will start with the opening outstanding at the beginning of the year, then how many granted during the year, how many exercise, how many outstanding at the end of the year. Same disclosure goes for the next, and because here there were no forfeited, so that is why it is not coming here, but there might be some forfeited or cases here that is cancelled as well, so that is coming here, right? So this is how the disclosure table will look like. Now weighted average price disclosure, how it is mentioned, remaining contractual life for the options outstanding as number of years. So 0.4 to 6.4 years is the outstanding period, right? And you can see here it is 6.4, here it is 6.7, here it is 0.4, here it is 1.4. So 1.4 minus 1, 0.4, 6.7 minus 1, ideally it should be 5.7, but there might be certain other changes because of this 6.4 it is still reflecting. Fair value of the options granted during the year ended. This is the fair value. Range of fair value actually the company has given because shares are being granted on different dates under the different plans, and share price or option exercise are also done on different dates. So a range is given, right? Then valuation technique model, the company has used the Black-Scholes model. So that might have been, available in the valuer report. So you can simply, extract the relevant information or details from those reports for the purposes of your disclosure. Then all these factors will be there in the valuation report and you can, quickly populate it from there. So this is how the disclosure basically will look like. So that is the sample disclosure. You can refer to some other, listed companies' financials on the NSE BSE website just for your better understanding how different companies are presenting these disclosures in their financial statements, right? Now, let's see what are the differences between the Ind AS versus the IGAP accounting for such share-based plans or ESOP plans. Now, under the IGAP, as at the start of the session, I had mentioned that there is no corresponding standard in IGAP, right? But there was a guidance note issued by the institute which talks about only about the ESOP plans, that is the transaction with employees. So transaction with employees are already or only talked about within that guidance note, but transactions with non-employee were not at all covered under the IGAP, and there was no guidance available. So that is the first difference between the Ind AS and IGAP, because Ind AS has a explicit standard, Ind AS 102 share based payment. On this, IGAP does not have any standard but a guidance note only, right? Guidance note. And in this standard, accounting is required to be done at the fair value, but guidance note said either at fair value or at intrinsic value. So there was a free choice available within the guidance note whether we can do accounting based on the fair value of the option or intrinsic value. But in the Ind AS 102, fair value is the only value at which accounting needs to be done. However, in the remote situation or rare case, when the company claims they cannot determine the fair value, then only intrinsic value approach is permitted with a sufficient disclosure why the fair value cannot be determined by the company. Graded vesting. So awards vesting is measured in substance on multiple awards. So whenever there are multiple award schemes, so and employees are anyway same, so all the scheme awards will be accrued basis on the rule which we have understood under the standard. So how the calculation needs to be done will be done in that very manner. But in case of IGAP, in case of graded vesting, where the share options or other equity instruments, graded vest in installments over the vesting period. So like 100 shares will vest in year 1, next 100 shares will vest in year 2, next 100 shares will vest in year 3. So that is called the graded investment. So guidance note has suggested the SLM approach for the expense recognition, but this approach cannot be used in Ind AS. Ind AS has the simple rule that calculate the total cumulative expense, deduct the expense for the preceding periods already recognized, and that would be the amount you would be recognizing in the year 2. There is no difference between Ind AS and the corresponding IFRS, that is IFRS 2, right? So whatever is the requirement under IFRS is the exactly same under Ind AS 102 as well. So there is neither carve-ins nor carve-outs in Ind AS 102 from the corresponding IFRS. So that was it from my side on this standard. And there are certain MCQs which we will be discussing, and there are 2 more practical questions which we will be covering, so that we have good hands on the theory as well as the practical application of the standard before we wind up the session. Company B has approved a bonus plan for its employees. Okay, so company B is approving a bonus plan for its employees, as per which the amount of the bonus will depend on the share price achieved at the end of the year as follows. If the share price is below rupees 10, the bonus will be 0. If the share price is between 10 to 12, the bonus will be 1000. And if the share price is above 12, then the bonus will be 1500. Whether the above arrangement will be within the scope of Ind AS 102? Yes, it is a equity settled. Yes, it is a cash settled. No, it is not a share based payment arrangement. And D, the company has an accounting policy choice to consider it as a share based payment transaction under Ind AS 102 or the employee benefit expense under Ind AS 19. So these are the 4 options. Can you please let me know the correct answer in the chat box? A, B, C, or D? Muhammad is saying C. Shruti is saying C. Okay. Others? Pooja is saying C. Okay. Everybody is of the view that this is not a share-based payment transaction. Correct. Because here the dependency is on the performance of the share price, right? And that is not what the standard intends to, right? And as such, there is no plan because company is simply deciding the amount of bonus if price performs, right? ABC Limited issues its shares to a law firm. Here the case is with non-employee as payment for legal services. Okay. Is this transaction within the scope of Ind AS 102? Yes. It is a equity settled. Yes. It is a cash settled. Yeah. No, it is not a share-based payment transaction. The transaction should be recognized as per the value of the shares issued. No, it is not a share-based payment transaction. The transaction should be recognized at fair value. What is the answer? A, B, C, or D? Viraj is saying the answer is A. Yes, it is equity settled share based payment transaction. Okay. Others? Muhammad is saying A, Pooja is saying A, Shruti is saying A. Okay. Correct. That's right. It is an equity settled transaction because law firm has, provided their legal services and receiving the shares in lieu of those services. So this is a share based payment transaction with the non-employee, right? Third question. A Limited issues stock appreciation rights to its employees. The SAR requires the company to pay the employees an amount equal to the appreciation in the value of 1,000 shares of the stock over the 2-year period. This transaction is within the scope of Ind AS 102. Yes, it is a equity settled. Yes, it is a cash settled. No, it is not a share-based payment transaction. D. The company has an accounting policy choice to consider it as a share-based payment transaction under Ind AS 102 or thus employee benefit expense transaction under Ind AS 19. What do you think? A, B, or C, or D? So if MCQs come up in the exam from this standard, I bet these are very easy and you will be, getting full scores. And for that matter, any MCQs from any standard, you will get full score if the answer is correct, right? So please practice MCQs for all. Muhammad is saying B, Viraj is saying A. Okay, now there is a different answer. Till now, I have been receiving unanimous consent for a same answer, but now it is getting different. Okay, others? Pooja is saying A. Okay, so Viraj and Pooja is saying A, Muhammad is saying B. So I will take up your question, Viraj, after completing this MCQ, third MCQ basically. So this is the answer. Yes, it is a cash settled. Now, there were two things in this question or in this MCQ. Number one, what the company was agreeing to pay. Company was agreeing to pay the employees an amount that is cash is being discharged equal to the appreciation in the value of 1,000 shares of its stock options. So instead of issuing 1,000 shares, the corresponding cash would have been paid to the employees to settle the obligation. So when company enters into an agreement to pay cash instead of shares, those transactions are called cash settled share based payment transactions, right? Why they are share based payment? Because the payment, how much payment finally will be made to the employees or non-employees, as the case may be, will be decided basis on the number of shares the company has agreed into the price of the shares on the date of the payment, right? So that is called a cash settled share based payment awards, and we have done the practicals around it as well in our previous session. Now the question from Viraj is there any difference between the SAR and the stock options? Okay, what is the difference between SAR? What is the full form of SAR? I have discussed it in my previous session. SAR is share appreciation rights. Share appreciation rights. Share appreciation rights, right? As the name suggests, how much appreciation there will be in the shares, that will be paid. So for example, grant date fair value is 50 rupees and the settlement date after the 3 years period, the fair value is say 150 rupees, then 100 rupees is the appreciation that will be paid or discharged to the employees. So share appreciation right says whatever there would be the appreciation over the vesting period will be discharged in cash, right? Provided you meet the vesting conditions as well as the performance conditions, if there are any, under the share based payment agreement with you, right? So that is called cash settled share based payment award. Clear, Viraj? Okay, let's try this one. ABC Limited issues share options to purchase company B shares, an unrelated public company, to its employee. Is this transaction within the scope of Ind AS 102? Yes. It is equity settled. Yes. It is a cash settled. No, it is not a share based payment. Yes, there is a choice available whether to account it for under Ind AS 102 or to account for it under Ind AS 19. Hanji. A, B, C or D? I'm waiting for your responses in the chat box. Answer is C. Viraj is saying C. Okay. Others? Muhammad is also of the view C. Pooja is saying C. Shruti is also saying C. Okay, perfect. Why it is C? Because the share options are being given to the employees of the company whom the company is acquiring, right? So this is a business combination Ind AS 103 transaction happening where the shares are being swapped with the employees of the other company being acquired, right? So that is a 103 business combination transaction, and that is explicitly, excluded from the scope of Ind AS 102 by the standard. Next question. ABC Limited enters into forward contract to buy 1,000 units of commodity, say for example gold, at a price equal to 2,000 of the ABC's ordinary shares. ABC can settle the contract on net basis, but does not intend to do so, nor does it have a practice of doing so. That is, there is no practice. The company has settled these type of contracts on a net basis. Is this transaction within the scope of Ind AS 102? Yes. Since ABC does not have a practice of settling these contracts on a net basis and also does not intend to settle it net, that's why it is in the scope. No. Oh, sorry. Yes. All commodity contracts involving issue of shares are covered under Ind AS 102. Third option. No. All commodity contracts involving issue of shares are excluded from the scope of Ind AS 102. Fourth. No. Ind AS 102 covers only those commodity contracts for which the intention is to settle net. What would be your answer on this? A, B, C, or D? Waiting for your responses in the chat box. Viraj is saying answer is option D. Okay. Others? Mohammed is saying answer is C. Okay. So neither C nor D. Answer is A. Why? This transaction is within the scope of Ind AS 102. Since ABC does not have a practice of settling these contracts on net basis and also does not intend to settle this contract under discussion on a net basis. Hence, it means the gold future, the company which has bought on, say, MCX, multi commodity exchange, company will take the delivery and will discharge its obligation, right? So when the company buys the goods and discharges the obligations, so it means they have entered into an agreement of purchase agreement, right? So they are purchasing the goods oblique services. In this case, it is a good because it is a commodity, say gold, and they are discharging by paying a price equal to 2,000 shares. So this is a cash settled transaction because they are not issuing equity shares, rather they are paying cash. But how that price or amount is being determined, that is the equivalent to the fair value of 2,000 shares, right? So 2,000 shares fair value amount will be paid by the company to discharge this obligation against which the gold has been purchased, or 1,000 units of gold or 1,000 units of the commodity has been purchased. So it is a transaction with the non-employee for the purchase of goods, and settlement is taking place in cash, which is determined basis on the fair value of 2,000 shares of the company. So this is a cash settled transaction, right? Now, the confusion in this question was because of the involvement of, first the future forward contract. Another confusion in this question was past practice, future practice, current practice, settling it net, not settling it net, right? So what is the thumb rule in this case? So thumb rule is in this case is whenever any such contracts are not settled on a net basis, right? Irrespective of the fact what was the past practice or what will be the future practice. I am talking about the accounting for the current contract in hand. So current contract in hand, if it is being settled on a net basis, then it means no, purchase is taking place, no goods are being purchased. Hence, it was a trading activity of the entity on the exchange to gain from the fluctuation or from the change in prices of the commodity, right? So that is a derivative transaction, hence covered under Ind AS 32 and 109 and explicitly excluded from the scope of this standard. We have discussed this on day one when we have been discussing the scope. So derivative transactions which are held for trading purposes with an intention to gain from the change in prices or fluctuation in prices, those are regarded as derivative transactions and those are accounted for in accordance with Ind AS 109, right? Financial instrument. But if we are intending to take the delivery and discharging the obligation either by paying in by issue of equity shares or a cash equivalent to the value of those equity shares, then if issue of equity shares is happening, it will be equity settled transaction because we have taken the commodity in our warehouse and giving the shares, or we have taken the commodity in our warehouse and giving the cash equivalent to those shares. So if it could have been equity settled had shares been issued, because in the current facts of the case, cash is being discharged equivalent to the fair value of 2000 shares. Hence, it is a cash settled transaction. Concept is clear? So whenever transactions are being settled on a net basis, they are not covered in Ind AS 102 because they are derivative transactions covered under Ind AS 109 and 32 financial instruments. And whatever transactions are covered under financial instrument standards are explicitly excluded from the scope of the standard that we have already seen in the scope, right? Clear? Point is clear? Thanks, Pooja, for the confirmation. Next. So these MCQs are scoring provided we are very much clear on the concepts and application of the same. ABC Limited has granted a right to its employees to receive a cash payment equal to the excess of the share price over rupees 20 multiplied by 2000. So 2000 is the multiplier, and above 20 rupees, whatever would be the share price will be discharged as a cash. For example, if the share price is rupees 30 at the end of the year, then employee will receive 20,000. That is 30 minus 20 is equal to 10 into May 2000 is equal to 20,000. This is an example, right? This is how the calculation will be done. This is subject to the employee continuing in the employment for 3 years. What is the correct classification of the above share-based payment arrangement? It is a cash settled, it is a equity settled, it is a compound instrument, it is not a share-based payment transaction. A, B, C, or D. So Viraj is saying A. Okay. Others, read the MCQ carefully, analyze all the four options before giving the answer. That is the key to, succeed in answering MCQs correctly. Pooja is saying A. Others, Shruti is saying C and Muhammad is saying D. Okay. So B is the only option nobody is liking, but A, C, D are the answers. So answer is A. Why? See, what can be done in the MCQ by the question setter? They can only tweak the language to just confuse us, right? So in this MCQ, except from language tweaking, other rest all things are very simple. And what is the tweak? Tweak is ABC Limited granted rights, okay, to its employees to receive a cash payment equal to or excess of the share price over rupees 20, right? So if the share price reaches 50, then how much will be paid? 30. If the share price reaches 100, how much will be paid? 80, right? So the delta will be paid, and with a multiplier impact of 2000, right? So for 2000 is the multiplier. So instead of mentioning that 2000 is the number of options explicitly, they hidden the fact and simply gave you the multiplier. So this multiplier is nothing but the share options, right? Options, number of options, right? And this right is nothing but the share option, right? Instead of mentioning it explicitly in the language, they simply use the word right. Now, you now understood that 2000 is the number of share option rights, and how much will be received. For example, the price minus the 20. So this 20 is the base price above which the appreciation will be given. So this is a clear-cut example of SARs. Yes or no? Share appreciation rights, right? This is called SAR, which I have just discussed in one of the previous MCQ. So except language tweaking, nothing else was there, right? So this is a cash settled. Hence, A option is correct answer. Clear concept? So MCQs are, drafted with an intention to confuse. So if we try to understand the real substance, over form of the MCQ, we will be able to, interpret it correctly, and accordingly, the answer will also be correct. Seventh, the conditions that determine whether the entity receives the services that entitle the other party to receive cash or other assets or equity instruments of the entity under the share-based payment arrangement are known as dash. You need to fill in the blanks on this. And that can only be done once we have a good command over the key terms definitions. So if we know how the key terms have actually been defined by the standard, then only we will be able to fill in the blanks whenever there are any asked, right? So what would be the answer? vesting conditions, Anish is saying. Correct. Because vesting conditions are the conditions which actually determines whether the counterparty will be entitled to receive the shares or the cash, as the case may be, or not, from the company, right? So vesting conditions would be the correct answer. Last MCQ for the day. Ind AS 102 covers share-based payment transactions among the group entities. Which of the following statements are true? Number 1, A. Transfer of equity instruments of the undertaking's parent to the parties that have supplied the goods or services to the undertaking. Transfer of the equity instruments of another undertaking within the same group as the undertaking to parties that have supplied goods to the services or services to the undertaking. Both A and B are correct. Neither A nor B are correct. So you have the options A, B, or C, or D again. So either you can say A is the correct, or you can say B is the correct, or you can say both are correct, or you can say both are wrong. So these are the 4 options. Viraj is saying answer C. That is, both are correct. Okay. What about others? Still analyzing the options? Correct. So C is the answer. Both the statements are correct. Right? Why? Ind AS 102 covers share-based payment transactions among group entities. That we have covered this concept where we have been discussing parent is the settler, subsidiary is the settler, parent is the settler discharging parent's own share or discharging subsidiary shares, and subsidiary is the settler discharging its own shares or parent shares, and similar 4 scenarios for the cash settled, right? Now, let's read it again. Transfer of equity instruments. So now here is the transaction equity settled of the entity parent. So parent's shares are being given to the parties that have supplied goods or services to the undertaking. So subsidiary company is receiving the goods from the supplier and giving the equity shares of the parent company, right? So that is the scenario which is well covered within the group transactions. Again, transfer of equity shares, that is again equity shares are being issued of another entity in the same group as the undertaking to the parties that have supplied goods. So either I am issuing the equity shares of my parent company, or I am issuing the equity shares of my subsidiary company, or I might issue the shares of another group entity that is a sister concern within the same group, right? So same logic applies to that. So whenever I issue my shares, those transactions are covered. Whenever I issue cash basis on my shares, those transactions are covered. Whenever I issue my other group entity shares, those transactions are also covered. And whenever I pay cash basis on the share price of the other entity, that transaction is also covered, right? And vice versa. So all the scenarios are we have already discussed. So basis on that, both the statements are true. Now, I have tried to, capture those questions which are there in your study material or the past examinations during our discussions so far in the chapter. Now, there are certain additional questions which, I have brought here from the examinations conducted by the Institute for the post-qualification certificate course as well, because I am the faculty over there as well. So these are the questions for your practice which you can, pick up, right? So 2 questions I can give you as a homework if you want to pick it up, or I can briefly discuss as well if you want to stay back, because it's 10 by now by my clock. So these are the practice questions. All the concepts and relevant questions we have already covered in the session. You just let me know if you want to stay back for next 10 minutes. I can discuss quickly both these questions. Okay. So Shruti confirmed. So let's quickly discuss. I will not take more than 5 minutes. An entity grants 100 share options to each of its 500 employees. So 500 is the number of employees and 100 is the number of shares options. Vesting is conditional upon the employees working for the entity over the next 3 years. Again, 3 years. So we are used to see this 3-year period, right? In all the questions, mostly. The entity estimates that the fair value of each share option is 15. So 15 is the fair value of each option on the grant date. On the grant date, the entity estimates that 15% of the original 500 employees will leave before the end of the vesting period. So in year 1, entity estimates 15% of employees will not be there. So how many will be there? 85%. However, actually what has happened, 20 employees leave during the first year, and the entity's best estimate at the end of the year 1 is still 15% on a totality basis of the original 500, right? During the second year, further 22 left, and entity revised its estimates from 15% to 12%. Now they are decreasing, that only 12% will be leaving the organization by the end of the third year. However, at the third year, further 15 employees have left. How shall the entity recognize the expense? Super simple question, right? No complexity at all. And this is examination question, right? So how many employees finally left? 20 in the first year, 22 in the second year, and 15 in the third year. So 57 employees, forfeit their rights to the share options, because these shares will be forfeited, will not be issued, because employees have left the organization, right? So 300 share options, that is 443 employees into my 100 share options per employee finally vest. The entity recognizes the following expenses. So in year 1, 85% is the estimate. So we will go by estimate, because this picture arrived to us only at the end of third year, end of third year only. So we do not know on year 1 how many finally has left, right? So we can estimate only. So basis on the estimation, 15% will leave, so 85% will be there. So 50,000 options into 85% into my 15 rupees into my 1/3, the weight for the period. So cumulative expense is 2,12,500 minus 0, because this is the first year. So total amount will be recognized. In year 2, options remain same, estimates revised, 88%. 15 is the fair value, 2/3 is the weight. So 440 is the cumulative minus this, remaining is recognized in year 2. And in year 3, finally, how many options vest? 44,300 basis on this calculation, right? And 15 is the fair value, and 3/3 is the weight, right? And why this is 100%? Because as such there is no estimate. This is just for clarity purposes, right? Because we have already calculated basis on the number of employees finally there. So 664,500 is the expense minus this much and this much, year 1 and year 2. So 224,500 will be the final amount which will be recognized in year 3. This is how the calculation will happen, right? Now, in this case, the only thing you might have noticed is, because the company's estimate is anyway exceeding the actual number of employees being left during that period, hence we have considered the estimate. Otherwise, if actual was higher, suppose instead of this 50, 20, it would have been, say, for example, 100 have already left and company estimates only 15%. Then in that case, the calculation would be for 400 employees because 100 have already left, right? So that we need to be careful while, doing these calculations. Hope this simple question is clear, right? Let's quickly see the next one. Rider Limited is reviewing certain events which have occurred since its year end 31st October 2013. The financial statements were authorized for issue on 12th of December. The following events relevant to the financial statements for the year end 31st October 2013. The company granted SARs, share appreciation rights. And whenever you hear the word share appreciation rights, SARs, it means it is a cash settled by default. No doubt about that. Correct? To its employees on 1st of November 2011 based on 10 million shares. At that date, rights are exercised. SARs provide employees with a right to receive equal to the appreciation in the company's share price since the grant date. The rights vested on 31st of October 2013, right? And the payment was made on schedule on 1st of December 2013. So settlement is happening. Payment is happening on 31st December. The fair value of the SARs as per the share at 31st October is 6, 31st October 2013 is 8, and 1st of December 2013 is 9. So 6, 8, and 9 are the corresponding fair values on the respective dates. The company has recognized a liability for the SARs on 31st of October 2012 based upon Ind AS 102 share-based payment, but the liability was stated at the same amount as at 31st October 2013. So company has, continuing with the liability which they have calculated on 31st October with the same amount on the next year instead of reinstating that liability, which is the requirement of Ind AS 102. Required. Discuss the accounting treatment. So what we need to do, we need to discuss the accounting treatment of the above events in the financial statements of the rider group for the year end 31st October 2013, taking into account the implications of the events occurring after the reporting period. So what is happening in this question? In this question, there are cash appreciation payments will be made. That is based on the SARs. So SARs is a cash settled. So anyway, we are clear that this question belongs to the cash settled equity transaction, share-based payment transaction. And cash settled requires to reinstate the liability at each reporting date as well as on the settlement date when the settlement takes place, right? Before doing the settlement. Now, we are supposed to discuss the accounting treatment. Company has not reinstated the liability and carrying the same liability, whatever they have measured on first year, right? Now, Ind AS 102 share-based payment requires a company to remeasure the fair value of the liability to pay cash settled share-based payments at each reporting date and the settlement date until the liability is settled. The share appreciation rights fall under this category, correct? Hence, the company should recognize a liability of 80 million, that is 8 rupees is the fair value on 31st October given in the question, and 10 million is the number of share option rights, right? Or the vesting date, right? The liability recognized on 31st October was in fact based on the share price of the previous year and would have been shown at 30 million. That is 6 into my 1/2 into my 10 million shares, half of the cost of the SARs vested over the 2 years. This liability at 31st October 2013 has not been changed since the previous year end by the company. The SARs vest over a 2-year period in this case, and hence on 31st October 2012, there would be a weighing of event cost by year 1 to 2 years. Therefore, additional liability of 50 million should be accounted for in the financial statements on 31st October 2013. So on 2013, there would be change on account of 2 factors. Number 1, year 2 weight and the fair value change, right? Both the factors are not yet accounted for by the company. Hence, we need to give the correct amount. SARs would be settled on 1st of December at 90 million. That is 9 into 10 million. So this is the settlement date fair value given in the question. The increase over the over and above 80 million in value of the SARs since the year end, that is 31st October 2013, would not be accrued in the financial statement but be charged to the P&L for the period 31st October 2014, because this is a settlement gain or loss. So settlement gain or loss, is being recognized when the settlement takes place, because they are already vested, right? So until settlement, this would be regarded as settlement gain or loss. But until the vesting, we would continue to recognize the expense for the cash settled transactions basis on the weights being applied for year 1/2, for year 2/2, right? And we will be using the corresponding fair values of those share options at the measurement date. In case of cash settled, it will be fair valued at each reporting date. So each reporting date would be regarded as the measurement date, right? So we were asked to discuss, so we have discussed the solution, right? If the question asks for journal entries as well, we can post them as well, correct? So that was it on Ind AS 102 share-based payments from my side. I hope I have tried to cover and explain all the concepts in detail along with all the relevant practical examples and questions. And the session was, informative for all of you. So with this note, this is over from my side. I'm happy to take if there are any queries from you, and wish you all the very best for your examinations. I'm just waiting for your response in the chat box if there is any query for next couple of minutes, and then I can log off if there are none. Thanks, Shruti. Okay. So I think there is no question in the chat box. So thank you for listening me patiently this morning, and wish you all the very best. I'm logging off. Yes.